Investing is a way to set aside money for the future, ideally in an investment vehicle such as stocks, bonds, or mutual funds that will grow in value over time. Debt, on the other hand, represents money that you have already spent and that a lender is charging you interest on. Left unpaid, that debt will grow and grow, with interest charges adding to your balance and incurring interest charges of their own. In the case for investing, as a general rule, if you can earn more interest on your money by investing it than your debts are costing you, then it makes sense to invest. For example, if you have a mortgage with an interest rate of 5% and a stock market index fund that is returning 10% a year, you will come out ahead by investing your extra cash in the index fund. On the other hand, if you have a credit card debt at 20%, you would be better off putting your extra cash towards paying that debt rather than investing it in the index fund. Unfortunately, it isn't always that straightforward. Investments can be volatile. The index fund might be up 10% this year, but down 10% next year. While there are investments that pay a guaranteed interest rate, such as bank certificates of deposits and U.S. Treasury bills, they tend to have low rates of return that rarely exceed the interest rates charged by credit card companies and other lenders. Another factor is more psychological: your risk tolerance. If you're comfortable taking the gamble that your investments will bob up and down with the markets, sometimes rising in value and sometimes losing in value, then you are a better candidate for investing than someone who would lie awake at night worrying about what the market might do tomorrow. In the case for paying debt, there are several good arguments for choosing to pay down debt rather than investing. The first, as mentioned above, is that you might come out ahead if your debt carries a relatively high interest rate. That is especially true with credit card debt. The average interest rate on credit cards tracked in Investopedia's credit card database was recently 19.62%. Few investments can match that rate of return. Another solid reason to pay down debt involves your credit score, a number that can be very important if you want to borrow money in the future, such as for a mortgage or a car loan. Having a low credit score can mean paying higher interest rates if you can get a loan at all. Your credit score can even affect other aspects of your life, such as the premiums you will pay for insurance, whether a landlord will rent to you, and even whether an employer will hire you. Credit scores are based on several factors. In the case of the most widely used one, the FICO score, your credit utilization ratio, the amount of credit you are currently using compared to how much credit you have available to you, accounts for a significant portion of your score. So, for example, someone whose credit cards are all maxed out is likely to have a considerably lower score than someone whose credit cards have been paid off or at least paid down to a more reasonable level. Paying off debt, particularly if you have a lot of it, can be a smart move for that reason alone. As with investing, psychology comes into play here too. If you're losing sleep over your debts, then you could be better off repaying them, even if you might get a better return on your money by investing. That's it for today. Hope you like and understand the point of the video and what you have to do. So please like and share the video with your friends, and for more finance-related videos, subscribe to our channel. And if you have any doubts or query regarding the topic, do let us know in the comments section.